Welcome to The Explainer. Today we're cracking open a technical analysis report on Clearmind Medicine, that's ticker symbol CMND, to really figure out what story the numbers are telling us. All right, let's just get right into it. The report immediately kicks things off with a classic question, one that every single investor has to ask when they see a chart like this. Are we looking at an amazing bargain or a really dangerous trap? And wow, this slide really puts that question in perspective. I mean, just look at these numbers. This stock was trading at over $2 a share in the last year. But right now, it's sitting at less than 35 cents. That is a massive, massive drop.
So, that's the million-dollar question, isn't it? Is this the golden opportunity to get in cheap on something with huge potential? Or is this what traders call catching a falling knife? Where you try to be a hero and just end up getting hurt.
Okay, before we dive into the arguments for and against, let's get a quick feel for the stock's personality. Its beta is 0.687. Now, all this really means is that even with that huge price collapse we saw, on a day-to-day basis, the stock is actually less jumpy than the market as a whole. Kind of interesting, right? It's just a little piece of context to keep in the back of your mind.
So, with that said, let's start with the bull case. What are the green flags here? What evidence is there that CMND could be setting up for a major comeback?
The whole argument for a rebound really comes down to this one super powerful idea. The stock is technically deeply oversold. And I love this analogy. It's like a rubber band. The sellers have just been pulling and pulling and pulling it down for so long, it's stretched so tight that it's just ready to snap back.
And what's really compelling here is how these 3 points all work together. First, you've got the technical indicator, the RSI, sitting at 17.62, which is basically screaming that the stock is oversold. Then, you've got a risk-to-reward ratio of over 8-to-1, which suggests the potential gains could dwarf the risks. And finally, you have a real-world reason for optimism, good news about a clinical trial. It's like a perfect storm of bullish signals.
But hey, if it were that easy, we'd all be rich, right? Of course it's not that simple. The report is just as clear about some very serious red flags, warning signs that this downward slide could have a lot further to go.
And this right here? This is the core conflict of the whole story. On one hand, you have the hope that these oversold signals mean a bounce is just around the corner. But on the other hand, you have the cold, hard reality. And that reality is that all the major data is pointing to a very strong, very real downtrend.
And one of the biggest dangers lurking in that reality is something called a volume trap. This is such a classic fake-out for investors. You see a big spike in trading volume and you think, great, buyers are jumping in. But what's really happening is that smart money is using that little bit of excitement to unload their shares onto you, trapping you right before the price drops again.
This chart just says it all, doesn't it? It shows just how powerful that downtrend is. Look at the current price, then look at the 50-day and 200-day moving averages. It's not just a little bit below them, it's miles away. And that is a textbook sign that the bears are in complete control of this stock.
So you've got this strong case for a bounce going head-to-head with an even stronger downtrend. So where do we go from here? Well, the report actually breaks it down into 3 possible paths that the stock could take.
You can think of these as the 3 main battlegrounds. In the bullish scenario, the buyers finally went out, they get that bounce, and they push the price up toward that 56-cent resistance level. In the bearish scenario, the sellers stay in charge, that downtrend continues, and they break below the 22-cent support. And then there's the neutral scenario, which is basically a stalemate. The stock just kind of treads water around 44 cents, with neither side able to get the upper hand.
Okay, so let's get to the bottom line. After laying out all this conflicting information, how does the analyst tie it all together? What's the final verdict?
So here's the key takeaway. This is not a simple buy or sell recommendation, not at all. It's way more specific. The report is basically saying this is a play for speculative traders only. The idea is to try and catch a quick bounce, but, and this is critical, you have to have a strict stop loss in place in case that downtrend takes over again. And you have to watch the volume like a hawk to make sure any rally is the real deal and not just another trap.
So really, the bottom line is caution, with a capital C. Yes, there's some potential here if the bulls can actually turn things around, but that potential is sitting in the shadow of some really high risks, that powerful downtrend and the threat of a volume trap. This is definitely not an investment for the faint of heart.
And that really brings us to the final question, and it's for you. We've laid out the case for the bulls, we've laid out the case for the bears, we've seen the analyst's very cautious strategy. The signs are pointing in 2 completely different directions. So, with all this evidence in front of you, which story do you think the chart is telling?